A lot of growth investors lost between 40 and 60% of their portfolio this past year. And some investor favorites also declined meaningfully. Amazon stock lost about half of its value. Tesla lost around 65%. And perceived safe havens like bonds, long-dated U.S. Treasury bonds, lost more than 30% of their value. So there's a lot of lessons here, in my opinion, that investors should internalize for 2023 in terms of how do they make the most out of this this next year. How do they make the most out of this investment cycle? How can they take, let's say, some of the pain that they've experienced in 2022 and turn it into a real opportunity to build wealth in the years ahead? So I'm going to share my thoughts, my own personal playbook for 2023 in this video. If you enjoy educational investment videos, please make a point of hitting that thumbs up, hit that subscribe button. And so let's dive into sort of thinking about the playbook for 2023. You're watching Unrivaled Investing. So I think the first main lesson that a lot of folks struggled with is buy quality. Quality holds up a lot better than everything else in tough times. Even Berkshire Hathaway was up, I believe, a couple percent in 2022, a year where the S&P lost nearly 20% of its value. And a big happy birthday to Charlie Munger. I believe he's turning 99 in just a couple of days, January 1st. So what do I mean by quality? So there's a couple of components that you should consider with quality. One is balance sheet. Does this company have the cash on their balance sheet? Ideally, a net cash position. If not, do they have very manageable debt structure? Do they have a balance sheet to handle a recession? Do they handle the downturns well? Or do they have a high cash burn where, hey, they're going to have to issue stock or issue debt in the future? That is not a good position to be in. That is not quality, I'd argue. You want to have lots of cash, or I'd argue a very robust business, a business with very high degrees of recurring revenue, 80, 90% plus recurring revenue. That's the type of thing that I want to see. I also want to see real free cash flow, because if you have free cash flow, once again, that puts you in that special quality basket where you could say, hey, I have free cash flow and I'm a recurring business. Even if there is a downturn, even if there is a stock market collapse further from here, if this is only the first leg of the downturn, even if there's another significant leg lower, great, because this company is generating lots of free cash flow. They're eager to buy back stock. And that's personally how I allocate toward my top positions, where I'm sort of saying, I want these share cannibals, these companies that go nom, 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 nom with their stock as the stock price goes lower. That's what I want to buy, because as the stock price goes lower, if the business is stable and not cyclical, that's another aspect of a quality business. You could say, hey, this is an advantage. This is a business where, hey, if the stock price falls in half because of a tough environment, but the cash flow is still coming in, what a wonderful position to be in to reduce shares at a much lower cost. So I look for these things. Another key aspect to quality is, I'd say, having something where you have a very obvious growth trajectory, where you say, oh, this is very, it's almost inevitable that you think that a business will grow X percent in the years ahead. Now, you don't want to pay for all that, ideally. And that's part of the reason why I bring up Charlie Munger when I think about quality is, he encourages you to pay a fair value for it, but maybe not the astronomical values that some investors have sort of gotten used to in the last few years of, hey, what's 20 times sales? It's saying, hey, let's have businesses with real free cash flow that this business is generating and has a stable balance sheet. So I think that lesson alone of buying quality, I think, would have saved a lot of heartburn this past year for investors, because it was the lower quality companies, the companies with maybe a lot of growth, but a lot of cash burn, that really suffered as interest rates moved higher this past year. And there was sort of a broad reset as investors said, well, wait a second, if this company is not generating, cash, and I can get a 4% yield approximately on my cash balances, you can get 3.8% plus at Interactive Brokers, link below. That gets investors saying, well, maybe this isn't the best place to be, especially if you have to think about raising more capital in the future, because this is a cash burn situation. And that's been a big wake-up call for a lot of investors. So I think the big reflection is, once again, buy quality, hopefully on sale. Another key lesson, and some investors, choose to ignore this. I personally feel like it's important to be aware of it, is just to respect macro. I mean, here's a great study from John Hussman. He's going back to 1940, showing that if you to break up the market by return from 4 different periods, when you're looking at the period that we're currently in, which is monetary tightening and unfavorable market internals, where things are broadly declining, looking at, credit spreads and things like that, that is arguably one of the worst periods to invest, where you're not generating significant returns. The real really great returns is when you have monetary easing and the internals are favorable. That's the exact opposite of where we are, and that's where the vast majority of market returns have been generated over the last, the better part of the last century. So that's a really important data point for investors to consider, which is know the macro, or at least where you are, and whether or not you're fighting, a headwind or if you're benefiting from a tailwind. And a lot of investors, I believe, sort of got, caught up with the easy money this past decade and forgot, well, wait a second, this is just an easy period versus the now tougher period that we're in with monetary tightening and unfavorable internals. I think another key aspect, and this is more of the playbook for 2023 to consider, is that, we're facing a tough set of, sort of variables here. Unemployment is still very low. The labor market's still very tight. Jerome Powell's made it very clear that he wants to see, a key component of inflation tied to effectively the labor market. He's talking about services that inflation come down meaningfully. That was still making new highs recently in terms of the indexes. And when you look at prior recessions, and a lot of people think it's a very high degree of, certainty that we'll face a recession in the coming quarters. If you look at prior recessions, those are the periods in gray, you almost always see this huge uptick in unemployment. We are nowhere near that right now. We're currently at 3.7% unemployment, which is barely up from 3.5. So if there's another gray bar, let's say in 2023 or 2024, one would expect some sort of unemployment uptick that we would see, and that would, I would argue, hurt the stock market. That would hurt the earnings power for a lot of companies, and that could result in much lower prices than what we've seen so far. So far, you could say the reason why the stock market is down is because of higher interest rates, where interest rates have gone from 0 to around 4%. I think another key aspect that investors should consider is that even though the S&P 500 is down a little under 20% from what I'd argue is an extremely frothy high, where people were eagerly, exchanging millions of real dollars for very ridiculous digital monkey pictures. And you had, record froth and record, I'd argue, fraud, what you saw with things like FTX. And you look at that and you go, wow, we're just barely off the highs, really, like 20% off of a ridiculous stimulated high. And you look at valuations, and even Vanguard, one of the largest, passive investment managers out there, they're effectively saying that valuations are still high and that U.S. returns maybe in the years ahead are mid to low single digits, going forward, because what you're talking about with the S&P 500 multiple is it's still around 19 times earnings. So this is by no means historically cheap. And so if you do see some sort of earnings pressure, you could see much, much lower prices, I'd argue. I've called out around 3,000 for the S&P. We'll see where it goes. I think another big lesson for investors, or at least me personally, as I consider my own personal journey, and this is sort of opening up about my own personal journey and sort of thought processes, is I look at, my portfolio and I look at how 2022, how everything played out, the ups and downs. And I look at what I started with at the beginning of the year for 2022 and how it ended. And I look at my top 5 positions at the start of 2022, and they average my top 5 positions, which was just like around 40% of my portfolio at the start of 2022. So some concentration, but not heavy duty concentration. Those 5 positions over the year averaged 20% return. So I was like, looking back at the year, I go, wow, I actually positioned the top 5 holdings in my portfolio really well. I mean, that, smoked a lot of the market, looking at those 5 and the top 5, like not one of them was one that lost like 30, 40, 50%. So I was pleased with how that was positioned. But my problem was that I think I took more of a too diversified standpoint, where I was sort of saying, hey, there's some winners that have done really well and I don't want to cut them too much. Like one of which was a company called C, which I still own. But, I bought it back in like 2019, 2018, and it went up significantly, more than 10x. And I trimmed a lot of it, at like $300 a share, but I didn't trim all of it. And it worked out extremely well, at that point. But that was like an example of something that really ate into my returns. And so I look at my top 5 and then I look at everything else. And unfortunately, everything else more than offset the strong performance in the top 5. So it's a lesson for me that like, hey, if you can sniff out quality, as once again, Charlie Munger reinforces, one should try to concentrate your portfolio in your best ideas, because it's idea number 6, 7, 8, 9, 10 those will be the ones that sort of bite you in the rear versus the things that you're like, hey, I have more conviction on, so lean more heavily into that. And part of which is that I was just sort of saying, hey, I don't like this investment setup. And I was saying that, to myself in 2022. I said valuations are rich. I expected Fed tightening. And so I just didn't want to make any big bets. But that was, clearly it's a lesson for me as well, sort of saying, hey, if you have a high conviction idea, because it's quality, because it has the balance sheet, because it has a business model that is stable or will be able to grow through a recession, okay, now I'm very interested in, am I getting a good value? And does this company have the buybacks? I look at my top, 5 holdings now. There's been a little bit of change, but still I'm looking at companies that have lots of buybacks and lots of potential to buy back more stock if it were to fall. And so that is what I'm looking for. But that's, for me personally, every investor needs to figure out what's right for them. I've, sort of reappreciated, that I want to concentrate more of my portfolio in my top holdings. So the question is, okay, so what goes on from here? How does 2023 play out? First of all, in full disclosure, this is not financial advice. So as, we look at 2023, I think there's the unfortunate reality that there's going to be some black swans and there's going to be some chaos. That's what I personally expect. That's sort of my base operations, how I'm considering 2023. I'm not trying to be Debbie Downer, like, look, folks, Happy New Year. I'm very excited about the continued progress for society. I think there's going to be some mind-blowing tech. Like, I think Google, for example, another stock that I own some shares in, Google is, I think they're very likely to respond to the latest chatbot, initiatives and sort of say, hey, we have something that really blows that out of the water. So I think that the tech developments are really going to impress people in 2023. There'll be continued amazing tech developments that we will see. But I think, and this is my concern, is that we have gone for so long with a society of dramatic and building debts, very high debt levels, that it creates the risk of a black swan. It creates the risk of some sort of financial chaos. And so I expect there will be something like that in 2023. I don't know exactly what will break, but I think when you have all these problems, it's sort of like, I'm based in California. California oftentimes has wildfires. When you have a lot of dry tinder, it doesn't take much to have this huge conflagration. It doesn't take much to have this just huge fire, this big, almost looks like a mushroom cloud. It gets so big. And so that's sort of what I look at when I see the Fed saying, hey, we're going to keep rates higher for longer. And I look at all the debt that's in the world, even looking at Japan, their inflation is picked up. They have just like 270, 260% debt to GDP. And their interest rates are like flat, like 0.5% versus 4% for the US. So I look at this and I'm like, that is just a recipe for disaster. Like, will that be what blows up? I don't know. I still think something does blow up. I'm not sure what it is. And then you say, hey, valuations really haven't gotten that cheap yet. Valuations 18 times, like if you look back at the history of recessions and when stock markets bottomed, you're not going to see valuations at 18, 19 times. You're going to see valuations at like 12, 13 times, maybe lower. David Tepper, one of the greatest hedge fund managers ever, he himself, he said, look, I'm naturally bullish. That's what I prefer to be. But right now I'm even leaning short. That's what he said, a week or two ago. And he's compounded at incredible rates, 20, 30%. And I think that gets back to you can try to find exceptional companies. And that's personally what I'm doing. I call that out to, my members at unrivaledinvesting.com. And so I am calling out like, hey, these are the companies that I do want to buy more of. And I've recently bought more of 2 of my top 5 positions where I'm saying, hey, these companies are buying back. And these companies I do think will perform well, even if there is chaos, because they have such a stable business model. So that's what I like to see. So I am adding a little bit marginally to, the businesses that I think have that high conviction where I'm saying, hey, this is the quality and the valuation isn't that demanding or the valuation's cheap. But I'm also saving a lot of dry powder, partly because, I'm getting that 4% in cash and once again at Interactive Brokers, and I can wait for when it's like, okay, so I'm concentrating on my best ideas, but I'm also saving a lot of cash for when things are just absolutely crazy cheap, where the minimum scenario is 200% upside. That's what I think you get in a period of chaos. So if I'm wrong, then you don't see that, period of chaos. You don't see that crazy cheap bargains. And hopefully the concentrated part of my current portfolio personally does well. And, this is how I'm currently looking at, the framework for 2023. I personally think one would be better off anticipating and saying, hey, have we really seen max pain yet? I don't think so. I don't think we've seen max pain yet. I don't think we've seen something in the financial system break. I don't want to see something break. I don't want to see unemployment go higher. But I'm a sort of a student of history, folks, where I look at that unemployment chart and go, is that where we are really the low, of this this bear market? Down 20%, where unemployment's at 3.7%. I mean, that's not what you historically showed. And I showed several decades. And then also you look at the macro of, Fed tightening, historically, like unfavorable market internals. That's historically, when the market generates very poor returns. So I'm looking at all these data points and I'm saying it's just not there yet. And you're not being compensated for it broadly with the market indices still around 18, 19 times earnings. If you have a different perspective on your playbook for 2023, I'd absolutely love to hear it in the comments below. A happy new year to everyone. And thank you so much for watching and hopefully subscribing to Unrivaled Investing. Thanks so much.